What I do know is that they're all fiat. They're all worthless. They're all, if you pull back and look at the big picture, being debased, and therefore anything real, and that includes gold and silver, but real assets, property, houses, whatever. In real terms, I am bullish on silver. I am concerned. People call me names and stuff, but I am concerned about its industrial impact going into the recession, being still in team hard landing. I mean, it's just a fact that silver's industrial aspect has had a larger influence on that market. So it doesn't pay to be religious about these things and ignore the facts.
Lobo Tiggre, CEO of Independent Speculator, shares his latest insights on gold, silver, and uranium. He is optimistic about silver, but raises concerns regarding its industrial demand due to potential recession risks. Exploring the impact of geopolitical dynamics, Lobo considers how actions from Russia might influence the silver market and create new demand. The Jerusalem Post noted that Russia could be altering its precious metal strategy, potentially benefiting silver due to increased demand. Silver could become a significant asset for the country's wealth fund, according to a report released by Interfax this week and cited by Bloomberg. Russia's draft federal budget outlines plans to significantly bolster its holdings in precious metals over the coming years. Notably, the budget includes plans to acquire gold, platinum, palladium, and silver for the first time. Considering all economic factors, Lobo discusses his predictions regarding currencies and their diminishing value. He highlights the importance of examining long-term charts of the dollar's purchasing power, noting a clear downward trend over the past 70 years since the dollar was detached from gold. Gold holdings valued at market prices account for 15% of global reserves. Consequently, the share of the US dollar in total global reserves, including gold, would fall to 48.2% instead of 54.8% of global foreign exchange reserves. The declining share of the US dollar indicates that it remains the preferred reserve currency for central banks, but is losing dominance compared to its role in trade invoicing and international financing, according to the Atlantic Council's Dollar Dominance Monitor. Now, we present clips of Lobo Tiggre's insights from his recent interview with Miles Franklin. Before we continue, please subscribe to our channel and activate the bell icon for timely updates.
What I do know is that they're all fiat. They're all worthless. They're all, if you pull back and look at the big picture, being debased, and therefore anything real, and that includes gold and silver, but real assets, property, houses, whatever. In real terms, those things are going up. And if I'm not a chartist, but to my mind, and I've said this many times, but for that one person out there who hasn't seen it yet, if there's just one chart about money that you need to look at and understand, it's the long-term chart of the dollar's purchasing power, even using CPI, which is giving the other side much too much credit, but the declining value of the dollar versus the gold-dollar exchange rate, aka the price of gold. It's a giant X. It's a little bit of a curvy X, but it's a giant X. Over the 70 years since the dollar was severed from gold, gold was free to have a little bit of price discovery, even if manipulated or phony, but some. It's a giant X. The dollar loses value, and the other ones lose value as well. I'm not just beating up on the dollar. All fiats are losing. And lo and behold, we have gold hitting all-time highs in other currencies before the dollar. So if the dollar is the last man standing, right.
There we go.
Right. So, and there's one of these on my website somewhere, but if you superimpose the gold on that too, it's a giant X.
It goes the other way, yeah.
And by the way, this makes it look like, oh, it lost so much more at the beginning. Well, that's because once you go from 90 cents to 10 cents, right? Going from 9 cents to 1 cent is on a percentage basis just as much, but on this scale showing the whole dollar, the 9 cents to 1 cent just looks tiny. So this makes it look like the dollar's been losing less value more recently, but that's an artifact of scale. It's actually not true. And this is partly why the X looks curvy, like I was saying.
Yeah.
It's just an incontrovertible fact. I am bullish on silver. I am concerned. People call me names and stuff, but I am concerned about its industrial impact going into the recession, being still in team hard landing. I mean, it's just a fact that silver's industrial aspect has had a larger influence on that market. So it doesn't pay to be religious about these things and ignore the facts. In this thing, it's a report. Are they even going to do it? Is it Putin rattling the West's cage? Just, who knows? The guy's a master chess player. It could be any number of things. But even if they do that, I mean, it's just silver is so much bulkier than gold. I would be very surprised if it amounted to much. But okay, let's say it really happens and they really start socking away a large amount of silver. That would, in fact, constitute a new end use of sorts. Like, 10 years from now, they might be forced to liquidate it or whatever. At some point, that silver could come back to the market. But while they're accumulating, that would be a new end use. That silver isn't coming back in the market. It's not going into photo panels. It's not doing anything else. It's just sitting in a vault somewhere in Russia. So that constitutes new offtake. If it was substantial enough, I do think it would matter. But yeah, I think it's premature to say that it's going to happen at all, and if it'll happen on a scale enough to matter.
Lobo Tiggre's analysis brings critical attention to the intricate link between the Federal Reserve's monetary policy, economic stability, and the role of precious metals as defensive assets. With the Federal Reserve pushing forward with aggressive interest rate hikes to combat inflation, the ripple effects on the economy are becoming evident. These hikes, while intended to control inflation, pose significant risk to the labor market and economic growth. An increase in borrowing costs tends to dampen business expansion, slows consumer spending, and eventually affects employment rates. In this context, Lobo points to the rising probability of a recession, emphasizing the vulnerability of the labor market as higher interest rates begin to impact business hiring and investment decisions. The landscape of inflationary pressures adds another layer of complexity. While inflation saw a momentary decline after the peak levels of 2022, it has not vanished. In fact, inflationary pressures are building once again, particularly at the input level. Input prices, which include the cost of raw materials and production, are rising at a pace that indicates persistent inflationary trends. The Core Producer Price Index, PPI, which excludes food and energy prices to provide a more stable view of inflationary pressures, has seen an uptick to 2.8% year-over-year. This marks a significant increase from 2.0% in late 2023 and signals that inflation might persist longer than initially expected, driven by both demand and supply-side factors. Precious metals like gold and silver have traditionally been regarded as safe haven assets, especially in times of economic uncertainty and inflation. When inflation erodes the purchasing power of fiat currencies, these metals often retain or even gain in value, making them attractive to investors seeking stability. This characteristic of gold and silver was clearly demonstrated in 2024, a year marked by multiple all-time highs in gold prices as the dollar's purchasing power continued to decline. With central banks around the world facing similar inflationary issues and geopolitical risks, gold and silver remain integral components of many countries' reserve strategies. In addition to inflation and monetary policy, Lobo also brings attention to geopolitical factors, particularly actions taken by Russia. Russia's recent shifts in its precious metals strategy, as noted in reports, could further influence the global demand for metals like silver. Russia's draft federal budget outlines plans to bolster its holdings of gold, platinum, palladium, and silver, with the intent of diversifying its reserves. By increasing its investment in precious metals, Russia could not only add stability to its wealth fund, but also drive global demand, especially for silver, which has significant industrial applications in addition to its status as an investment asset. This trend points to a broader movement among nations to reduce reliance on the US dollar as the primary reserve currency. According to the Atlantic Council's Dollar Dominance Monitor, the share of the US dollar in global reserves is gradually declining. As central banks diversify their reserves, the importance of precious metals as alternative stores of value becomes more pronounced. This shift away from the dollar highlights an emerging trend in international finance, where central banks prioritize assets like gold and silver that are less vulnerable to inflation and currency depreciation. Lobo's insights underscore a broader financial environment where traditional assets like precious metals provide a hedge against economic instability and currency volatility. His prediction suggests that as the Federal Reserve's monetary policy pressures continue to shape the economic landscape, assets such as gold and silver will likely see increased demand, not only as safe haven investments, but as strategic assets in a diversifying global economy. Let's get back to the interview.
What's different is I was expecting, based on past behavior, they would drop the ball, bad things would happen, the Fed would tighten too much, too high for too long, according to mainstream economics, break something, right? The Fed breaks something, typically, the labor market. There would be bad things happen. And then as the recession became undeniable, or that it was coming would become undeniable, then the money helicopters would fly. So my thesis was never we're going to see years of soup lines and that sort of thing. My thesis was that the mainstream medicine of throttling the economy to deal with inflation would throttle the economy, bad things would happen, and then the money helicopters would fly again. The fiscal dominance thesis says, or what it's starting to look to me like it may imply, the money helicopters have been flying all along, maybe in stealth mode, maybe without big, huge announcements, or not even stealth mode. Like the grossly misnamed Inflation Reduction Act is a huge spending bill. Okay, but that was years ago. You'd say, well, yeah, it was voted on years ago. Appropriations happen subsequently, and then the spend takes time before shovels hit the ground and the money starts circulating around. This is, classic example of long and variable lags. What I'm saying is I'm still in the hard landing. There's a difference between, rosy cheeks due to health and rosy cheeks due to makeup. And, you can stimulate an economy so it looks healthy, but it's not the same as organic, healthy, internal growth. So it does matter. But in terms of inflation and GDP and the kind of numbers that economics models use and so on, and this includes investment houses, includes Wall Street, not just the Fed, not just the people in Washington, right? We may not get that undeniable hard landing. We may get a completely deniable hard landing. What I'm saying is I think the damage is still being done. And as you and I speak, we just got the JOLTS report, and it showed fewer job openings and fewer quits, which is really interesting. The quits rate, that tells you that the psychology is changing. It's one thing for the companies to say, oh, yeah, maybe we're a little worried. We don't want to hire so many people. It's another thing for these people who got all their stimmy checks and who had the great resignation and all this stuff, for the people to start saying, you know what, maybe it's not a good time to quit my job. At least I've got one, right? So I see the data still backing up my thesis. You don't go from zero interest rates to 5.5% without something giving somewhere. But if there's a lot of fiscal stimulus at the same time, that could be masked. That's the makeup, is what I'm saying, as opposed to the bona fide health of the economy. So we'll see. We are at crunch point now. It's rare for me to make predictions. As you know, I try to avoid the prediction racket. And certainly, as Doug Casey says, if you're going to make predictions, don't say when they're going to come true. Just make your prediction, right? But I sincerely believe, and I may be wrong, but I sincerely believe that we are at that point now where either I'm wrong, there is no hard landing, and the Fed pulled off its miraculous soft landing or no landing, or I'm right, and the cracks that we've seen appear and widen in the labor market, really since last July, that is serious. So, like, even in the few 2 months we have left in this year, I think we start to see this unraveling and then the response, or I'm wrong and the fiscal dominance has masked it and we get the soft landing or no landing scenario. But here's the takeaway, though. Never mind the theory. That's the macro theory. That's the freebie. Here's the pig, right? If I'm right, it's very bullish for monetary metals, gold and silver. It's bullish for anything real, because the money helicopters will fly and anything real will do well in that highly inflationary environment. If I'm right, however, it's too early to jump into some realish assets like oil and copper, because they always get hammered when there's recession news. Always. That's an unbroken track record.
Investors are eyeing silver closely as prices show strong upside potential, recently approaching the $35 per ounce mark. Although silver historically lags behind gold, it has reached levels not seen since early 2012, despite still being well off its all-time high of nearly $50. As both gold and silver experience significant climbs, market participants are increasingly curious about the sustainability of these price increases and what it may mean for future investments. For investors, these developments underscore the importance of a diversified approach to precious metals. Many see silver not only as a hedge against inflation, but also as a valuable industrial commodity with applications in renewable energy and electronics. In times of economic uncertainty and currency devaluation, the dual role of silver as both an industrial and precious metal enhances its appeal, suggesting that strategic exposure could be beneficial. As silver continues to gain momentum, investors are considering various strategies to navigate the shifting landscape of precious metals and fiat currencies. Some may focus on exchange-traded funds (ETFs) tied to silver, while others might pursue direct investments in silver mining stocks, aiming to capture value from both price appreciation and potential dividends. Long-term holders also find value in physical silver, viewing it as a tangible asset that protects against the potential risks associated with fiat currency depreciation. Please share your thoughts on these strategies in the comments section. If you found this video informative, support our channel by subscribing and turning on notifications to stay updated on our latest insights. See you in the next video.